Hi, and welcome. You're listening to the X22 Report. My name is Dave, and this is episode 1564A, and today's date is May 9th, 2018, and the title of the episode is, no doubt about it, these indicators show we have an economic problem headed our way. Let's get into the economic collapse financial news. Now, we've been looking at many different indicators here in the U.S. and across the world, and we're starting to see things really fall apart. I mean, things are just declining very, very rapidly. And this is just not in the housing arena. It's just not in the retail arena. It's pretty much everything that we're looking at. If we're looking at student loan debt or credit card debt, savings, if we're looking at manufacturing, if we're looking at retail, if we're looking at all automobiles, if we're looking at all this stuff, what we're seeing is a decline in all these different sectors, and they're starting to accelerate. Actually, in many of the countries, we're starting to see certain cracks in the bubbles that have been blowing up for a very long time. This is the bubbles that have been blowing up since the last financial crisis of 2008. And out in the UK, we can see that retailers, well, they have just suffered the sharpest sales drop for 22 years in April. The British Retail Consortium latest health check shows 3.1% fall, the biggest dip since its survey launched in 1995. Britain's retailers have suffered the sharpest drop in business in more than 2 decades. And we can see out in Canada the housing bubble is popping and things are starting to really break apart. Here in the United States, we are seeing so many different indicators. They are flashing red signals saying something bad is headed our way. And one of the signs is consumer debt. Now, we see that consumer debt has been rising since the last financial crisis. During the last financial crisis, we hit around $2.6 trillion in consumer credit debt. And today, we've completely surpassed that. We are now at $3.82 trillion. And this is just unbelievable because we are just piling on debt faster than the overall economy is growing. Now, if we go back in time and we go back to 2008, we can see there was a short period of time between 2008 to 2010, 2011, where a lot of consumers, they deleveraged mostly by defaulting on their debts. But it didn't last long because, again, what are we seeing in the economy? A lot of people losing their jobs, a lot of people getting lower paying jobs, wages are decreasing, and people need to survive. Now, a lot of people don't want to use the funds that are in the bank, so they keep those funds in the bank and they use credit to make ends meet because you don't want to have zero in the bank just in case something big does happen or your credit cards get canceled and you need that cash. So a lot of people turn to credit. And this is what we've been seeing because over the 10 years since the first quarter of 2008, consumer debt has now surged 47%. Over the same period, the consumer price index has increased by 16.9%. And when we look at credit card balances, I mean, we have basically beat the all-time record, which was back in the fourth quarter of 2008, when everyone was just piling on a lot of debt during that period of time. We had the huge housing bubble. People were taking out the equity line of credits on their homes because home prices were continually moving up and up and up, and everything just started to crash, and people just had a lot of debt, and this is why a lot of people defaulted. But back then, we had credit card balances of about $977 billion. Well, we beat that. We're at $1.03 trillion. This is an all-time new record high. And you need to remember, the central banks, they thrive on debt. They love student loan debt. They love credit card debt. They love automobile debt because we need to understand how their system works. They prosper by having people in debt. They can control debt. They can give you free money where they create it out of thin air and say, hey, take out an automobile loan, you can get a car. Take out a student loan, you can go to college. Use credit, which is just free, funny money, and you can purchase whatever you need. They can control that, but they can't control people getting jobs, people actually saving and using real cash. That's a little bit more difficult, and this has been their problem for a very long time. Right now, we see wholesale inventories Wholesale sales and inventories, they have disappointed in March. They both slowed by 0.3% month on month. Wholesale sales slowed from an upwardly revised 1.1% month on month in February to 0.3% month on month in March. And if we look at the sales breakdown, we can see durable goods in March, they are down by negative 0.3%, automotive down by negative 1.6%, furniture down by negative 1.7%, lumber down negative 1.3%, and it goes on and on and on. And we can see that things, again, are indicating that we are headed to major problems. Now, if we look at additional indicators, we can see that there are economic problems ahead. And these are actually signals letting us know something bad is headed our way. Now, again, people think that the economy is doing well. If you ask people on the street, they'll say, yeah, the economy's doing great. Everything looks good. The corporate media is out there sending mixed messages right now. Some say the economy's not that great. Everything Trump's doing is not that great. Others are still on the bandwagon that everything is fine. Because you have to remember, nothing has changed. All the calculations, everything that's been done is exactly the same in what has happened since 2008. They haven't changed anything. They're following the same exact manipulated calculations. But we can see that things are not fine. Right now, the yield curve is dangerously close to flattening. Soon, it will invert. And if we look at the second 10 rule, the spread between the 2-year Treasury and the 10-year bond, we see the spread is at the lowest it's been since the Great Recession of 2008. 43 basis points, that's it. To put this all in perspective, if the Fed hikes just 2 more times, which is 50 basis points, and the 10-year keeps sticking below 3%, then the yield curve will invert. This is important because the yield curve inversion, when the spread turns negative, has preceded the last 7 straight recessions. If we only look at more modern times, say the last 30 years, we can see the spread collapse negative before a recession strikes. So once again, there is a huge problem here. There is also the cash hoarding problem, and that's a bad signal of economic growth. When things are very uncertain and become difficult, and we know things are difficult for many people where they've lost their jobs. They might have gotten a part-time job or 2 part-time jobs, but they're not making the same amount of income. Wages, they are declining. Many people who have lost their jobs can't find a job. People hoard their cash, and they don't like to spend their cash. They rather use their credit cards, like we were saying before. And they'll put off dining out, buying things they wanted, and instead they keep their money in their bank. They keep it there for a rainy day. Today, Americans are saving at the highest levels since the 91 recession. They are skittish about the future. Now, if we go back in time, we can see the difference in checking accounts. The average checking account customer has around 3,700 stashed away. The median amount in checking accounts since 91 was 2,263. Anything lower than this signifies the economy is doing well. Anything that is above indicates the economy is not doing well. And the problem coincides with the soaring credit card debt. And what that means is Americans would rather go into debt and finance their consumption while paying some interest instead of spending all of their money, their actual cash, up front. Another indicator is the South Korean Export Growth Indicator, the SKEG. Many wouldn't have guessed that South Korean exports are a great leading indicator, but they are. Historically, looking back in time, they're an incredible indicator. And what does this tell us? It gives us a picture of what global corporate earnings are going to be. So when we look at this, we can see that the SKEG indicator turned negative. When did it turn negative before? It turned negative in 2008. It turned negative back in 2001. It turned negative going back every single time. And what were we in? We were in a recession. And this means that the global corporate earnings will also turn negative. So we're looking at all these different indicators, and they're all showing us pretty much the same thing. And if we go back in time from all the other indicators we looked at, we can see that they're all starting to make sense now. Now, we know there is a battle right now between the central bank, Trump, and the Patriots, where they want to gain the narrative of who brought down the economy, why it was brought down, who was responsible for it. And this is what is happening at this point. This is why the Fed, it seems that they didn't raise their rates once again, and Trump held off on the tariffs. And we can see right now that they're both, using this stare down game where they both want to gain the narrative. But if we look at what has been going on and we look at the actual economic growth, well, the actual economic growth is slowing down. And if we go back in time, when we go back to the 70s, 70 to 73, and we see the percentage there was at 6%. If we go to 75 to 1980, it has dropped down to 4.5%. If we go from 80 to 81, the economic growth was about 4.4%. If we go to 82 to 90, the economic growth was 4%. If we go to 91 to 2001, the economic growth was around 3.5%. If we look at 2001 to 2007, the economic growth was about 2.3%. And today, the economic growth is much lower. You have to remember the economic growth that we're reporting on, which is GDP, they manipulated these numbers to make them a lot better. If we look at the unmanipulated numbers, it is well below 1%. Actually, there are some reporting that these numbers are in the negative territory. So we are seeing economic growth slow, and it's not improving. Now, if we take this and we look at the international GDP growth, and we look at the three largest developed market economies, that would be the US, the Eurozone, and Japan, well, they're not improving. We're not seeing them increase, we're seeing them decline over time. And if we look at 2017 to 2018 right now, all we're seeing is GDP growth has rolled over, and it is declining right now. This is not a good sign. This is telling us that we are headed towards a recession. We've seen this before, back when we had other recessions, when we had the Great Depression. We also see we have problems in the credit arena, and we talked about that eventually what's going to happen is credit's going to freeze up. When credit growth drops below 2%, a recession almost always follows. Right now, bank credit growth is down to 0.6% since the beginning of the year. This is pretty darn ugly. And we see right now that all these different indicators are pointing to one thing and one thing only, a recession. And these are the manipulated numbers. Strip away the manipulation, this economy is a complete and utter mess. It's collapsed already, and we're just keeping the whole thing propped up. How do you keep something propped up like this without anyone noticing? Well, you change all the calculations, you hand out the manipulated numbers, you create currency, you keep the banks afloat, and you pretend that everything is fine. They did this prior to 2008. And people say, well, what do you mean? What did they manipulate? Well, they told us these subprime securities were AAA. Everyone believed it. They kept investing in them. Pensions invested in them. Then we come to find out they lied. That's a manipulation. Same thing with all the corporations where they were saying that the corporations are fine. AIG's fine. Bear Stearns is fine. Lehman's fine. Oh, by the way, we just need this one bailout. Don't worry about it. Otherwise, they're great. Oh, wait, we need another bailout. Oh, we need one more bailout. So if they needed 3 bailouts, and then the automobile industry needed a bailout, the banking institutions needed a bailout, we relied about the subprime securities, that's how they kept the entire system afloat. They even told us that real estate, that's not going to decrease. It's contained. Everything's fine. While they were saying that, people in California were walking out of their houses as the interest rates continually increased because they couldn't pay back their adjustable rate mortgages. They couldn't even lock in. And many people were just leaving their homes. So they have the ability to manipulate. Now, since that period of time, they've learned how to manipulate pretty much everything, how to manipulate the stock market, how to manipulate all the numbers to the 10th degree to make you believe that the economy is really doing well. But when we break it down and we look at all these indicators, we can see the economy is dead in the water. The central banks know it. Trump knows it. Those in his administration, they know it. Everyone knows it. Across the globe, they know it. China knows it. Russia knows it. Why do you think they're trying to get away from the dollar? Why do you think they're trying to separate themselves from the U.S.? That's why they created their own payment system. This is why they've been hoarding gold. This is why they have their own exchanges. This is why they created the petro yuan. This is why they've done all of this. Why do you think countries are looking at cryptocurrencies? and moving away from the dollar because this is the only alternative they have right now. They're doing all this because they understand, they realize what is happening. The whole thing is falling apart. And when the whole thing falls apart and crashes, guess what? A new system will be born. This is the transition. We have to go from this old to the new. This is why you need to be ready and prepared. Listen, everyone, thanks a lot for listening. Be well, be safe, and especially be prepared. Thanks a lot.